Santosh, let's begin in the next 2 minutes. We are also live on YouTube today.
Yeah, Gushneet. Hello.
Yeah, Santosh. I'll
Yeah,
just put it on chat.
sure. Hi, good morning, ladies and gentlemen. Welcome to this webinar on Talk with Expert series. Before I start, I'd like to wish lots of happiness, plenty of health, wealth, and more importantly, insight and wisdom to take right decision and also ensure that execution of financial plan to create, to manage, and grow wealth. The year 2020 has been good for someone, bad for someone, or ugly for someone. But when you actually look at it at 2020, I think we should all thank the year 2020 for bringing a lot of insight and wisdom to us. We got lessons which normally people tend to get in 10 years, 20 years, or sometime on some lifetime. But in just span of just 365 days, or lots of ups and downs has taught us a lot of stuff. And as a tendency as a human being, sometimes we take it to extreme. Either we become very aggressive, or sometimes we become very, very pessimistic, and we say, oh, this is the end of the world, and I want to just come out of my business or come out of my investments. So we would like to take you through some couple of, I believe most of you may be knowing what in mutual fund. So I'm not going to go into details of mutual fund per se, but take you through some instrument within the mutual fund which is available for us, where a conservative customer or a customer who's starting off fresh, or a student who's starting off fresh with the investment, they can start taking the baby step with this. And someone who's an HNI or ultra HNI, if he's not comfortable with the market currently, okay, he can park his money for some period, maybe 3 months, 6 months, or it could be 12 to 18 months. So we start this journey. So I always say in my all session that please focus on music and not on noise. This is a chart of Sensex for last 40 years. Since Sensex inception, this is the chart. If you look at it, many events has happened, which was very, very serious at that particular point of time, and market corrected depending on the market sentiments and depending on the market liquidity situation. But what you observe is, if you look at this line over this period, okay, it is upward trending. But has it been a straight line? No, it's not been a straight line. Just hold on screen. So it's not even a straight line. There have been ups and downs in this entire journey. But one thing which we are clearly knows is it is an upward journey. Look at what happened in March. In a span of just 1 month, we saw market corrected by 40%. That's the index corrected by 40%. Good quality stocks corrected by even 60-65%. But what happened was, for the best reversal which I have seen personally last 25 years of my own journey, okay, I have never seen a V shape, a pure V shape journey happening in a span of just 3 to 6 months. And this is what happened in year 2020. Like in March 2020, when the Nifty touched around 8,000, if someone had asked me, Santosh, what do you think? When will the Nifty touch 14,000? I would have said most probably end of 21, or maybe, sorry, end of 22, or maybe beginning of 2023. But I have never thought about that Nifty will touch 14,000 in 2020 itself. But that's the market is all about. So instead of getting into too many macro stuff, okay, something which we don't understand or something we just can't feel about it, okay, let's not get into that situation. What we need to do is basically is if I want to create a wealth, have my asset allocation in picture, focus on that asset allocation. If I had X amount of percentage to be invested in equity, I need to be invested in equity, in debt, gold, real estate, and cash. Look at this asset allocation quint. Mint newspapers publishes this every year on the first week of January. So this is the latest one which they have published last week. So if we look at it for year 2020, the small cap has given the best return among the top 10 asset classes and sub asset classes. Small cap has given the best returns, followed by gold. If you look at gold for last 2 years, 2 calendar years, gold has given the best return and is number 2 within the top 10. Look at 2018, the gold has given 8% return. So looking at this past return, normally as a human being, we will have tendency, oh, I think because since Sensex is around 48,000, Nifty is around 14,000, let me move out of it and get into gold. Because last 3 years have been good for us for gold. But if we do the mistake of that, looking at the past return, we may end up what happened way back in 2011. Look at it. In year 2011, gold was the number one highest return fund of 29%. Looking at 29% return, if I had invested in gold in 2011, what happened in 2012? It was a number 7. And in subsequent next 3 years, look at gold at bottom 10, number 10. For 3 consecutive years, gold was in the lowest return rung. So never invest based on what you have seen in the past return. Like today, a lot of people are looking at investing into gold or looking at investing into international market, because international market and gold has given the highest return if you look at it. However, we are investing for future, which is unknown. So based on past return, if you do our investment, there is a chances that we may fail or the return expectation may not materialize. So what one need to do is basically invest in an instrument which stabilizes my return, where the what you call the standard deviation is low, volatility is low, and I get an opportunity where I have some part of my investment invested into domestic equity, some part into international equity, some part into debt, and some part into gold. So do you have such fund? Yes. So in coming session, in the coming slide, I'll be showcasing it to you. Second thing I told about the holding, because one is creating the wealth, but also managing it. Holding on to the wealth is also important. Like today, you have some requirement, maybe 3 months down the line, 6 months down the line. Now, none of us know whether there will be a correction again. Yes, there is a possibility. Maybe 5%, maybe 10%, or even more. Now, in such a scenario, is there an instrument which is slightly safer than current my equity position? Yes, there is one fund which I'm going to talk to you about. This is a journey of Nifty 50 for the last 26 years. So if you look at it, this is the year, say if I started in 1995. So what is the return after 1 year? What is the return of 2 years? After 3 years since 1995. So if you look at entire, this is the return per se. So this is the 1 year return. Very first year, the Nifty gave return of 23% negative. In the next year, it was 1% negative. So 2-year return of the Nifty was around 13%. But since in 1997, Nifty gave a return of 20%, the 3-year return was -3, and the 4-year return became -7, and then 5%. So you look at for the calendar year 2020, Nifty has given a return of 15%. But one thing which I want to highlight to you is look at the 10-year return. Initially, way back in 1995 or even till 2003, the 10-year return used to be annualized, used to be around 17 to 18%. But look at what is happening post 2006. The 10-year return are dropping below 10%. So what I want to highlight is, we have heard the story of Sensex giving 15% return since inception. Yes, it's a fact. However, can we expect going forward Sensex also continue to give a 10% to 15% plus return? My personal view is no. Okay, we need to moderate our return expectation going forward, simply because when India was growing at a GDP of 8 to 10% with inflation of another 6 to 7%, we were getting a normal return of 15%. But now since my GDP is growing at the lower rate and my inflation is expected to grow at the rate of 4 to 5% going forward, so 4.5% or 5% inflation and 6% of GDP, real GDP. So one should be looking at around 10 to 12% return going forward. So one has to moderate the return expectation. If equity is going to expected to give 10 to 12% going forward, then definitely even the fixed income return will be at the lower range. 20 years back, a bank FD used to be around 10% or 12%. Today, a 1 year bank FD or a 5-year bank FD is giving me what? 4 or 5% return. So we need to moderate our return expectation so that we don't start moving from one fund to another every year or every 3 months or 6 months. When you invest in a fund, okay, you're investing for some goal, which could be 3, 5, 7, 10, or 15 year plus. So when you invest with the horizon of a long term, and you have to review your portfolio, but don't churn your portfolio on a yearly basis. One thing which I want to highlight on this chart is there have been 26 years of Nifty. Out of 26 years, 18 years has been positive. That means 65% of time Nifty has been positive. Only 35% of time the Nifty has given negative return. And if you look at the three biggest fall has been 2008, 2011, and 1995. Except for these 3 years, okay, we hardly seen huge correction in the market. But still our tendency is we fear. We fear a lot because loss always gives a major pain than a gain. And we always say market डरावना है, market में loss हो सकता है. Yes, loss हो सकता है provided if you invest only with the 6 month, 1 year, 3 year horizon. But moment you hold it for 5, 10 plus years, the chance of earning a positive return is very, very high. That's the probability. Look at it here. Moment your investment horizon keeps increasing 9, 10, 11, 12 years, the minimum Nifty return has been 100%. So that means there will be no negative return in that financial year for 10 years, 15 years. If Nifty has given you positive return, definitely the fund which you will invest will definitely give you higher positive return. So please invest for a longer horizon and don't look from 1, 2, or 3 years. I believe majority of you know what mutual fund is, but for a benefit of people who are just new or fresher or a student, what is the advantage of mutual fund? I personally believe that 90% of any investor, be a retail, HNI, or a ultra HNI, even a business or a corporate, 90% of your financial need can be met by mutual fund. First and foremost, it's flexible investment. One can invest 1,000 rupees, one can invest lakh rupees or a crore rupees. Second thing, fund is managed by a professional management which have 24/7 taking care of this investment, not only for you, but various investors who are invested into the fund. You get a diversification. Say for example, if I want to invest 1,000 rupees per month into SIP or even 5,000 rupees per month, can I buy Page Industry? Can I buy Infosys? No. By 5,000 rupees, I can buy just 2 Infosys. Page Industry, I can't buy. I can't buy MRF, which is at 77,000 rupees. But by investing into a mutual fund, even if I'm investing 1,000 rupees or 5,000 rupees or 10,000 rupees, I get an opportunity to invest across these stocks, which could be worth any amount between 100 rupees to 10,000 or 50,000 rupees. Liquidity. I think this is the best part of the mutual fund is you can always get immediate liquidity. T+2, you get your money into your bank account. This is not possible in case of real estate, and it's not possible for other instrument which is illiquid. Another part is tax benefit. When I say tax benefit, not only by ELSS. Yes, in ELSS you get ETC benefit, but that other tax benefit which you get when you invest in mutual fund is maybe the fund manager is buying and selling the fund, the securities. He must be buying X securities, sold X securities or Y securities. The taxation is applicable to you only when you sell the instrument. So if you're holding for 3 years or 5 years, there is no tax to be payable by you unless you sell that units. Whereas if you hold a bank fixed deposit, every quarter you have to pay advance tax on the interest that has accrued to you. Whether you got that interest money into your bank account or not, you have to pay advance tax. So your power of compounding gets hit. Whereas in case of a mutual fund, whether you invest in equity or in a debt mutual fund, you get an opportunity to invest for a long period of time, making power of compounding to work for you and without any tax implication till the time you're holding on. Very low transaction cost compared to other opportunity which you have. And finally, there is the safety and systematic investment, because safety in the sense, SEBI as a regulator has done a commendable job in last 10, 15 odd years. Every year they are trying their best to ensure that the safety of the instrument are far, far better than what they were in the past. Yes, they also learn something happens, they learn and they take corrective measure and they keep on doing it. So best part of mutual fund is that the transparency, you know, entire portfolio, you know the details of the return. You can compare the returns of one scheme with the other scheme. If the scheme is underperforming, you can come out of it at any point of time, which is not possible in the other instrument. It's just like a buy and hold strategy. You can't do anything about it. So these are the advantages of mutual fund, which many of us are knowing about it, but hardly taking action about it. You know, as of today, overall population, only 2% or 3% of the population are invested into mutual fund. So the thing is, we have never, instead of having 25,000 crore or lakh crore of investment, but predominantly is the investment from corporates or H&M, but retail customer have not taken benefit of it. And unfortunately, last couple of months, I have seen most of the retail investors are existing more mutual fund and getting into IPO. Please understand, in IPO, you're getting just one lot. You're just getting one lot. Even if that shares goes by 100% or 200%, how much difference is going to make your life? Because if you get 10 share or 20 share, even if it doubles, will it make any difference to your overall portfolio? No. So if you have already decided to stay invested and get a mutual fund as the avenue to go your build up, please stay invested. So as I said, we'll be talking about some new instrument. There are some the arbitrage per se, I can tell personally, hardly retail investor has invested into this. More HNI, ultra HNI, and corporates are definitely using this fund, but retail investors are not using this fund because one is they may not be aware of it, or just looking at the return, they find, okay, this is not a great fund. Please understand, arbitrage fund from a taxation perspective is treated as equity fund. However, the returns are actually fixed income return. How? Because what arbitrage fund is? Arbitrage fund, what it does basically is they buy and sell securities or the product in different markets. That means I buy in cash market and sell in future market, or I buy in BSC and sell in NSE and lock in my gain. And the benefit of arbitrage fund is basically is you have lower volatility, one, and more importantly, your return, okay, is more or less assured to some extent. How? Just take this example. Say that the stock XYZ, the stock in the cash market is trading at 1,000 rupees. Say example, I'm just giving example purpose. Say this is Reliance share. The Reliance share is trading at 1,000 rupees. However, Reliance future is trading at 1,010 rupees. So what the fund manager will do is they'll buy Reliance in cash market at 1,000 rupees and sell future at 1,010 rupees, and they'll lock it. So this 10 rupees is now assured for them, because what they're doing to do at the month end, they'll reverse it. The future market will end at a zero level and they have made a profit of it. When the arbitrage fund started a few years back, maybe 8 or 10 years back, at that time, arbitrage returns used to be around 7 to 8%. But as inflation, interest rate has started coming down, in last 1.5 years, the return has been in the range of 4.5%, 3.5 to 4.5%. So when look at the return, they say, "Arey, isme to 3.5%, 4.5% milta hai." What is the return you're getting in a savings bank account? 3.5%. That is entirely taxable at 30% or 40%, whichever tax slab you are. With an arbitrage fund, since it's an equity fund, if you sell in less than 1 year, you pay 15% tax. If you sell after 1 year, you pay 10% tax. And this tax is applicable only when you sell it. Whereas in a bank fixed deposit or a saving account, every quarter you have to pay tax, advance tax, because you earn the interest. Arbitrage fund, I personally believe at this particular point of time where market looks on a valuation wise, looks pricey. If you look at the latest Nifty level at 14,200, the Nifty peak, the trailing peak is around 39 level. Price to book is around 4. Dividend yield is below 1.5. If you look at market cap to GDP, now we already crossed 100%. So when you look at this parameter, it's pricey. So if you already made some gain in the market and you need some fund, I'm telling you, only if you need fund to utilize, then only you need to book profit, else don't book the profit. Just stay invested. So if you need some fund, maybe in 3 months down the line, 6 months down the line, or 1 month, 1 year down the line, you can sell the fund and park the money into arbitrage fund, because at least you're holding on to your capital. In arbitrage fund in last 8-9 years, I have not seen any fund giving negative return. It may be lower return, maybe 1% or 2% in some cases, but has not seen a negative return. So at least you're trying to protect your principal. And second benefit is basically, I said, the tax advantage. You're earning a return of fixed income of 3.5%, 4.5%, or 500%, depending on the interest rate applicable during that period of time, but you're paying a tax of equity. The second fund, okay, the arbitrage fund, actually, we always say in asset allocation, when you start your financial planning, you need to have emergency fund. You can park your emergency fund in arbitrage fund, because you can keep it for anyone between 3 months, 9 months, 12 months, even for 18, 24 months. You can park the money into arbitrage fund and ensure you're earning a decent return, which is growing over a period of time. So you can look at from emergency fund investing in arbitrage fund. Second fund is dynamic equity fund. In last couple of years, it has started getting more prominent, what do you call them, attention. However, I have seen retail investors are hardly investing into it. Again, two questions. One is because they don't understand what this product is all about. Second, the return, because when they compare this return vis-a-vis active fund, when it is bigger on the moving on the higher side, the returns will be slightly lower. But I tell you, at this current market juncture or any market juncture, dynamic equity is another must-have fund in everyone's portfolio. Why? First and foremost, the dynamic equity fund make the allocation into equity or into overall portfolio based on some parameter, predefined parameter. Okay, so it's invest into 2 to 3 asset class. One is in equity, second is debt, third is cash, and arbitrage position. And what they do is basically based on the parameter which they have. I have taken the example of Motilal Oswal dynamic equity, which use Motilal Oswal value indicator. What it does is they take into consideration the price to equity, price to book, and dividend yield. Taking all these three into parameter, they look at what is the valuation today. If the valuation is very high, they reduce the equity portion, that is the cash portion, and take portion into arbitrage, but ensuring that at any point of time 65% is invested into equity fund, reason being to ensure the tax benefit of equity and not treated as debt. So I'll just take with an example. So you look at it, when market was at the high level around 11,000, 12,000 level, the actual net equity level invested by dynamic equity of Motilal Oswal was around 44%. When market corrected drastically by 40% in March 20, look at what happened. The net equity level from 44% was increased to 72%. Now in March, when market corrected, how many of us has actually increased our stake into equity? I will say 99.9% has not invested, including me. Okay, we didn't, because we got scared. We didn't invest. But this fund, because they are following a formula, they invested heavily into equity when market corrected. And they kept on increasing their position as market was in the cheaper valuation. But as Nifty started again moving up, slowly the equity portion, the cash equity portion, they started reducing it. So what they do is basically dynamically they keep increasing or decreasing the position into cash equity based on the parameters of valuation. So as of today, okay, when Nifty is at around 40,000, 14,000 level, our cash position, net cash position in net equity is around 30 to 40% level. Balance is into arbitrage, and up to 35% is into debt instrument. So if tomorrow going forward, if equity valuation comes down, again, the net equity position will be increased. So what they do is basically is they invest cash equity of 30 to 40%, arbitrage position of 25 to 35%. So ensuring that every point of time, the net to gross equity is above 65%, so that the fund is treated as equity fund and not as a debt fund. So that you get an advantage of 10% and 15% taxation, and ensuring the volatility in your portfolio, the return volatility in the portfolio are better compared to other active fund, be a large cap, a mid cap, or multi cap. I personally say everyone should look at having a dynamic equity. The example out here is of Motilal, but definitely there are other dynamic equity fund available in the market. Please look into it. The one thing which I would like to say is, please do not go basis on return. I can't name out here, but there is a fund house where actually they are doing the reverse. I say Motilal or ICICI, what they do is basically when valuation is very high, they bring down net equity level, where there is one fund house where actually they increase as equity market keep increasing, they're increasing their equity allocation, net equity. So I don't know how that dynamic works, but then that's the strategy of each fund houses. So one can't say whether right or wrong, only the time will tell us. So sometimes you may see a very such aggressive fund house giving very aggressive return today. But if market corrects, it will be badly hurt. So you should look at this fund for someone who is a conservative, someone who is a moderate, or someone who's just starting off fresh into the equity market. I personally believe they should be looking at this fund. And the third fund, which again very few retail investors are investing into, is the multi-asset fund. I showcased you the asset class returns and sub-asset class return. Like in 2020, small cap has given a high return followed by gold and international equity. What happens is now as individual tendencies, अरे NASDAQ ने अच्छा return दिया, अरे S&P 500 has given a great return. So let me invest my 50-60% of portfolio into NASDAQ equity. Gold has given excellent return in the last 2-3 years. So let me invest and balance money into gold. What if there is a reversal? Can I time the market? No, market timing is very, very difficult. We have to ensure that we have to be stayed invested. So how do I ensure without getting into looking at the return and investing my portfolio? There is a fund called multi-asset. Motilal started off, and now more and more AMC are coming with this multi-asset fund, where based on some parameter, they invest into all the asset classes: domestic equity, international equity, gold, and cash. That cash is a debt fund. And you're getting an opportunity based on the market parameter. The fund manager on your behalf will be doing this exercise. I'll just give you an example. 2000 burst of NASDAQ and Indian market. NASDAQ had given an excellent return till year 2000. From 2000 to 2010, the NASDAQ returns were below 0% or around 0%. So it was a lost decade. So if I had invested in NASDAQ fund or something just because based on return as of 2000 for 10 years, next 10 years, I would have made no return. Yes, from 2010 to 2030, they had an excellent return. Whether this continue for next decade, no one knows. So how do I go about it as a retail customer who doesn't have time or research opportunity to look at each and every market and understand each and every market? Like for example, today valuation laws looking very high, but still markets are going up. Now what should I do as a retail customer or even HNI customer? Don't have time to figure it out. So in such a scenario, investing into asset fund like multi-asset fund gives me opportunity to invest into across all the spectrum. One part which I have to tell you in multi-asset fund is this fund is predominantly investing into debt and gold. So from a taxation perspective, this will be treated as a debt fund and not an equity fund. But still, being a debt fund also is excellent because if you invest, because when you're investing, you have to invest for minimum 3+ years or 5+ years. You get a long-term benefit of 20% with indexation. What is indexation? I'll be talking about next slide. So you get an indexation benefit. So you are paying first instead of 30%, you're paying 20%, and after indexation, the actual tax payout will be around 4 to 5%. So if you invest within debt fund or in the multi-asset fund, which is treated as debt taxation, you will get the indexation benefit and also about to earn a power of compounding, which is normally not available in a bank fixed deposit or saving account. So this is the asset allocation of this fund or multi-asset. They invested into 14% into domestic equity, that is Indian market, around 11% in international equity, 11% in gold, and balance into treasury bills and stuff like that. So look at, again, it's using the same movie brand. So since currently the movie is trading between 120 to 30 levels, the equity investment is around 10%. Around 70% are into debt, 10% into international, and 10% into gold. That's the minimum they will be investing into. So if you are not invested, you can look at this opportunity in this new calendar year 2021 and come with at least 3 to 5 years investment horizon. Please do not invest today and start looking at your return and comparing it with Sensex or comparing it with any large cap or mid cap or multi cap. This is a different asset class investment. You have to stay invested for minimum 3+ years, 5 years. So this is the performance. Like multi-asset fund was just launched last year, August 2020. So we don't have more than 3 months of 3 to 4 months of performance gap. But as far dynamic asset is concerned, in case of Motila, it was launched in 2016. In case of Birla and HDFC, though you see 2000, but they please understand they were earlier fund which got converted into balance advantage fund. As a balance advantage as a strategy, it started somewhere around 10 years back. So we have a history of around 10 years of balance advantage fund. So if you look at it, the returns, okay, if you look at purely based on return, it could be for 1 year return could be anywhere between 15 to 7%. But as you go up, okay, 3 years and 5 years, you start seeing some consistency coming in. Because I may be lucky in 1 year, but not necessarily lucky every year. So one way have to look at from 3 year or 5 year return when you look at it. But more important than return, focus on what strategy that particular AMC is doing it. If you're comfortable with this strategy, then invest. But don't, as I told you, invest based on return, because instead of bringing my net equity level down, if as a fund house is increasing net equity when market is going up, definitely I'll be giving you higher return because market is going up. But what happens when market reverses? The return will come down. This is about multi-asset fund, and this is arbitrage. If you look at it, arbitrage fund from 1 year perspective is 4%. But please understand, as I said, arbitrage fund, we are investing more from an emergency fund perspective or for parking for a short period of time. Return though is 4%, but if you take the taxation part of it, I'll be paying only 4% or 10% taxation. Whereas same money it was keeping in a debt fund, because in debt fund you have to hold for minimum 3 years, I'll be paying at my marginal rate of taxation. If I kept it in saving bank account or in a fixed deposit, I'll be paying 30% again. Finally, of course, this is not a theme or something which I want to talk about, but this is about ELSS. Since we are in the JFM period, we are having our, if you are a salary employee, you'll be getting mailers from your HR to submit your tax investment. So ELSS, among all the opportunity available under ATC, the best investment opportunity for 3 reasons. First and foremost is it has the lowest holding period of 3 years. So locking period is just 3 years. Second thing is you're getting an opportunity of diversified portfolios. Third, transparency. You know where money you're investing in, where the fund has invested into. Fourth, you're getting the market link return, and you're getting an opportunity to move and move out. Okay, if the fund is not performing after 3 years or 4 years. Where if you invested into a bank FD, you're locked for 5 years. In case of PPF, you're locked for 15 years. In case of insurance, you're locked for 5 years. So ELSS is the best avenue to invest under ATC. Please invest under ATC only if there is a gap of ATC. If majority of us who are a salaried employee, we already having a PF, that is Provident Fund. We may be having already insurance premium. If you have children, then your school children education fee will be there. If you're having housing loan, majority of us will have, your principal component is taken care of. So in such case, you don't have to invest into ATC investment. So invest only if it is there requirement. Just because there is some ATC investment, don't go on investment. There's no need for locking in because we already have other opportunity to invest into. This is a tax taxation. If you're investing in a mutual fund, which is equity oriented, your long term is treated more than 12 months. If you're holding for less than 1 year, you have to pay 15% taxation. For more than 1 year, it is 10%. The dividend which you get, okay, from this financial year, dividend is taxable at your marginal rate. So if you are 10%, you'll be paying 10%. If you are 30% tax, you'll be paying 30% taxation. And in case of debt mutual fund, for treatment of long-term capital gain, you have to hold it for minimum 36 months. That is 3 years. So if your investment horizon, if you are holding it for more than 3 years, it is treated as long-term capital gain. With less than 36 months, it will be treated as short-term. So you have to pay a marginal rate of taxation. This 10, 20, 30, whichever slab you are into. If you are selling after 3 years, you'll be paying 20% with indexation. And any dividend which you earn will be taxable on your marginal rate of taxation. I told you I'll be talking about benefit of tax indexation. So this is the example. So in case of equity asset, 1 year is the long-term decision taking. Because real estate, it is 2 years. Earlier it was 3 years. Now it is 2 years. For gold or for debt fund, it is 3 years. That is 36 months. So here I'm taking an example. I invested into a particular product. Say I invested into debt fund of 10 lakh rupees way back in April 2010. That time, the cost inflation index is determined by Minister of Finance, around June of every year, they notify this number. So cost inflation number of April 10, which is falling in financial year 10 and 11, it was 167. I sold it in the year April 19 at 30 lakh rupees. What are the cost inflation at that time? That is 1920, 289. So inflation adjusted cost. If suppose there was no indexation benefit available, so my income tax would have treated 20 lakhs as my tax rate, as my capital gain. So on 20 lakhs, suppose if I'm at 30% tax, I have to pay 6 lakh rupees as income tax. But since I'm investing into debt fund, okay, I'm getting the advantage of adjusting it with the inflation. So government says, okay, you bought it at 10 lakh rupees. Now due to inflation, your cost is now 17 lakh 30,000. So actual net gain for you post adjusting of the cost is 12 lakh. On that 12 lakh, you have to pay 20% taxation, which comes to 2 lakh 64,000. So look at the saving which I end up making. I've saved around 3.5 lakhs. This is on 10 lakhs. What if it was 1 crore? So if you invest in a debt fund or in a multi-asset fund for more than 3 years, you get this benefit of indexation. In India, historically, the inflation rate has been around 6 to 7%. And if you know, even currently also, our inflation is 7%. So you can expect the CI, the cost inflation factor, will be around 5 to 6% going forward also. Though RBI has a benchmark rate of 4%, but except for few years, 1 or 2 years where we saw inflation was around 4%. But historically, last 10, 15, 20 odd years, inflation in India has been 7%. And looking at the current market scenario where oil prices are going up, food prices are going up, even the steel, cement prices are going up, my personal view is that we'll continue to be seeing a higher inflation level, maybe 7 to 8%. And this will be the status. So that's all from my side. There's one more slide which I want to take because since now I have 3 more minutes. So I'll just take you on this, on the SIP part. Because this slide is something which I really love to talk and discuss about. We all start with saying, okay, I want to invest for a long tenure. I start my SIP journey. I say I'm coming with the 5 years, 10 years, 15 years, or 20 years horizon. But moment market corrects, I redeem. I stop my SIP or I redeem, and which is happening in really today in last 10 months. If you see SIP per month, SIP used to be around 8,200 crore in March. Inflow of SIP inflow was 8,200 crore. Today it is at 7,300 crore. It's dropped by around 900 crores. Why? Because people have stopped their SIPs or redeemed their SIPs. Why? Because market corrected in March, April, May. Suddenly they saw a negative return. A 5-year return as of March was negative for SIP. But just holding it for another 6 to 7 months, same SIP return from -4 or -10 has become +10 or +15. So to give that example, I have taken these 3 funds. This is not a what you call sale pitch of a fund. It just give for example purpose. So we have taken large cap, multi cap, and mid cap. So if you invested in these 3 funds in year 2007, that is you started for Jan for till December 2008. Because you know December 2008 market had corrected badly by 50-60%. So I had invested 10,000 rupees per month. So I invested around 2,40,000. Look at the value of 2,40,000 at the end of 31st March. It was 180, 161, 158. That means earning a XIRR of 24 to 34%. When I look at it, अरे जो भी मैं पैसा डाल रहा हूँ उसमें लॉस ही हो रहा है. So what is the first thing which we do? Come out of it. I don't want to make losses. Have you come for 1 year, 2 years? No, you have come for 10, 15, 20 years. Then why you are redeeming it? So if I decide, okay, Santosh Shetti is telling me or my advisor is telling me to hold on to my investments, if my goal is 10 years or 15 years down the line, let me hold it down. So I decided to hold it for another 4 years. Look at it. From negative return of 24% to 34% in next 4 years, my 7 years return or 5 year return has become 6 year return has become positive 13, 8, and 14%. And the same SIP I'm continuing till 31st of December, that is till last month. Look at the return, positive 11, 13, 14%. But look at the value. I invested 15,60,000 rupees religiously on 1st of every month in this 3 scheme. My 15 lakh 60,000 has become 39 lakh in case of large cap, 47 lakh in case of multi cap, and 49 lakhs in case of mid cap. This is the power of equity. You just need one good quarter or year, your entire return period changes. Your entire return, what do you call them, numbers changes. So please do not allow going forward also to have any market impact. Maybe it could be for short term, maybe it could be for long term, maybe 1 year, 2 year. Do not stop your SIP. Keep investing. Please understand, you should be very happy. If my SIP is going on, I should be very happy if the market is coming down. Why? Because I'm getting higher units. For the same 10,000 rupees, I'm getting a more number of units. And tomorrow when market goes up, which we saw in the first slide, focus on music and not on noise, market has corrected. But what is the long-term chart? The long-term chart is the upward. If there's an upward going, this is the excellent opportunity for me where I need to look at it. So that's all from my side. I hope this session has provided you insight into new opportunity to invest, that is arbitrage fund, dynamic fund, and the multi-asset. And I said, as far as SIP is concerned, please keep investing regularly and from a long-term perspective, because creating wealth is very, very easy. Like today, someone must have bought some stock which has gone by 100% or 200% in a span of 3 months. Suddenly believes that he has become a king, he has become a god. And then they start taking a very higher risk. And suddenly market corrects, or maybe that particular stock corrects. Entire wealth which was created in 3, 6 or 1 year is lost. We have seen KBC winners, okay, who has won 1 crore or 5 crore. What is the status of them? They got created. They created 5 crore or 1 crore. But what is the status today? They lost all money. Creating money to some extent is easy. Managing it is the most difficult one. And when I say managing, is managing ourselves, our emotions, our thought process, our journey of investment. This is most important and crucial, which most of us miss. If I can't manage my money, which I've created, how can I grow it? How can I transfer it to my next generation? So I hope this session has helpfully help you in going through understanding this products, the new product which we have showcased to you, and we hope that you start your journey on wealth creation. If you're not already started, if you already started your journey on wealth creation, then managing it and growing it. With that, I stop my session out here. Wish you all the very best. I'm open to Q&As right now. I think I see there are 2 questions. So let me just address them. Okay. Team, if you have any question, please put it on the Q&A session. So there is one question is basically, how do I go about my investment journey? Good question. First and foremost, I'll tell you, get some advisor. Please do not go based on what media person is saying. Someone coming on the television and giving you advice. Okay, don't go by that. Have some advisor. Understand the advisor experience also, because at the end of the day, it's your money. Ask him why he or she is telling you to invest in so and so instrument, and start your journey. Starting your journey is very important. Whether you start with 1,000 rupees or 10,000 rupees or 50,000 rupees is immaterial. The earlier you start and keep investing regularly and have patience of 5, 10 plus years, you will definitely create a huge wealth for yourself. In the market, we are all about saw WhatsApp going on. If you are invested with pro so and so X amount, and now it has become XYZ amount, or in case of Asian Paint on HDFC Bank, it's good to hear. But question is, how many people have invested for so long? Like yesterday, we had a session. So if someone, the example of an Asian Paint, again, this is just for example purpose, not a stock advice. If I invested 1 crore rupees in Asian Paint in the beginning, that is 35 years back, what would be the value? Do you think it would be 10 crore? 100 crore? No, it is 1,500 crore. 1 crore invested in Asian Paint in the beginning, when it started off at the stock market, Today value is 1,560 crores. That's the power of compounding. That's the real, what do you call them, power of equity. Even debt fund, okay, I'll tell you, there are some debt fund in the last 10 years, they're given 10% plus. Today, due to paucity of time, I could not cover the debt fund part of it because I didn't want to bring the different focus on thing. Maybe we'll have one more session purely on debt fund. Again, there are excellent investment to invest, okay, without taking much risk on your portfolio. Okay, do not go for higher 50 basis point or 100 basis point return, because your underlying product in the debt fund could be unrated stock, unrated securities, or a low rated securities. So one has to be very, very careful. Do not run for returns. Look for the quality of the fund. Look for what is the theme of the fund, how the fund manager is managing the fund, how he has been performing for over the last 3 years, 5 years, 10 years. Unfortunately, in India, we think long but work short. Equity, I personally believe that government of India, if they can hear me out today, okay, they should make long term for income tax purpose to 3 year or 5 year instead of 1 year. Because your debt fund is 3 years. Earlier, real estate was 3 years, now it's 2 years. But equity fund, they have made it 1 year. They actually should make it for 3 year or 5 years. Because by making it 5 years, equity fund, automatically we as the individual, like when ELS says, my money is locked for 3 years. Because it is locked for 3 years, I end up earning a better return than in a normal open-ended fund. Why? Because after 1 year, I churn. Arey fund acha return nahi kar raha hai, nikal jao. But in ELSS, I had no option. I have to stay invested. So I'll wait for 3 years. And again, a mistake which is done by a lot of investors in ELSS is, because in ELSS, lock-in is for 3 years. Exactly after 3 years, they redeem. Question is why? Did you invest to redeem after 3 years? No, you are invested for creating wealth. So why can't you keep investing the same fund? Keep adding it up and stay invested with it. Please understand, as an investor, I don't need more than 5 to 7 funds. Yes, 5 to 7 mutual funds are sufficient. As because we do some analysis of some portfolio client, they have 20, 30 mutual fund. Hey, mere, each mutual fund have around 20 to 30 stock minimum. Some people have even 60, 70. So if you have 30 mutual fund, 30 into 50 stocks, look at 1,500 stocks. Why? It doesn't give any diversification. Mutual fund is a diversified portfolio. So 5 to 7 mutual fund are sufficient. If you are on an aggressive side, you can have more on mid and small cap. If you are more on a conservative hybrid side, you can have more on large and mid cap fund, and the fund which I told you about multi-cap fund and a dynamic fund. Sufficient. One large cap, one large and mid cap, one multi-cap, one mid cap, one small cap, one multi-asset fund. Sufficient. You don't have to diversify too much. 5 to 7 mutual funds are sufficient for your wealth creation. Review your portfolio once in a year. But when I say review, does not necessarily mean you have to redeem it. Check out. If the fund is not performing very, very badly, then hold on to it. But do not invest from a perspective that, अरे यार भी एक साल हो गया, अच्छा perform नहीं किया, review किया, so I want to move out of it. Do not do that. You have to stay invested for a long duration. Second thing, can you recommend MF for a starter? So, okay, as I said, I just gave the example. For starter, if you're starting off, since I told you in my presentation also, if you're starting off, I'll tell you to start with multi-asset fund and with a dynamic asset fund. Why? Because you will experience a lower volatility than a large and mid-cap fund. Once you are experienced for 1 year, 2 year, you are comfortable with the volatility which you are seeing in this fund, you can go into large cap, then start building into aggressively into multi-cap, mid-cap, and small cap. Yes, there is a question. I want to invest 10,000 rupees per month. I have already showcased to you the schemes. Okay, we can look at it. There's a question from Mr. Nitesh Jain. Any suggested fund for retired person and VRS person for regular income? Okay, Mr. Nitesh, please understand income, regular income, because we are so used to as a pension fund, mutual fund or any product which is regulated by SEBI, there's no assured return. So when an AMC can't give you assured return, as a distributor, I can't tell you that XYZ fund will you get a regular return. What you can do is, as I said, SIP, systematic investment plan. There is something called systematic withdrawal plan. You create your own pension plan or you create your own withdrawal plan to get your regular income. Say, for example, I am a retired person today. I got, say, 1 crore rupees. Just for example, hypothetical, I got 1 crore rupees. So I invest into 4 or 5 mutual fund, which includes this dynamic fund, multi-asset fund. But I don't start immediately. Let me be very upfront with you. Allow that fund to grow at least for 3 years. Allow the fund to go for 3 years. End of 3 years, start your systematic withdrawal plan. Say, tell the fund houses, I want every month 25,000 rupees, 50,000 rupees, or 1 lakh rupees, depending on whatever your fund flow requirements is. So every month, you will get a redemption of 1 lakh happening every month. The benefit of this is, okay, since you already completed 3 years, whether if you invest in debt fund or equity fund, you will be long-term capital gain will be applicable. Since you allowed the fund to grow for this 3 years, when you're getting the money to you, SWP, in your bank account, the chances that you're getting more on return rather than on your principal. If you start off immediately, say I invested 1 crore and start withdrawing from the very first month, and assuming market doesn't grow, it's just that flat 0%, what you're doing, you're actually withdrawing your own principal. So 1 crore से अगर पहला 1 lakh निकाला, so my principal from 1 crore becomes 99 lakhs. So you're withdrawing from my own money. I'm not earning any return. But if I allow it to grow for minimum 3 years, I'll tell you, and start your SWP, then you, whether you're a VRS person who is a retired person or someone who wants to have regular flow coming in for school education, for something like that, you create your own stuff. Please do not go for dividend option. It is a very, very bad option. Why? For 2 reasons. One, dividend is not assured. So you don't know whether dividend you'll get next month or not. Even if you get the next month dividend, whether the dividend amount will remain the same or not. And third and most important, from this financial year, dividend is taxable in your hand at the highest tax slab, that is at 33% or 30% or 20%, whatever margin it is. Where if you do a SWP, okay, in form of equity fund, you'll be taking short-term capital gain, that is 15% if you're withdrawing immediately less than 1 year. If you're withdrawing after 1 year, in case of equity fund, you pay 10%, so you're saving at least 20% from dividend perspective. And if you're doing after 3 years in case of debt mutual fund, again, you are paying 20% taxation after indexation. So please start your SWP, be equity or debt. I'll personally believe it should be after 3 years. So you are allowing your fund to generate some return, grow your NAVs, and start withdrawing it. There's a question from Vijay. What is the outlook strategy from here for investing in debt fund? Are corporate bond fund, short-term fund with duration of 3 years safe, or should we use equity saving fund to increase return? Both the options are good. Within the debt fund, I will advise currently to invest into short-term fund and a banking and PSU fund. If you are slightly on a higher risk taker, then you can look at corporate bond fund. The reason being is, as you know, RBI has cut interest rate in last 2-3 years. Same in abroad. But what is happening is, if you look at really, the real rate of return which you are earning today is negative. We all heard about internationally, people are getting -1% return. But what is the inflation over there? Again, -1%. So -1% and -1%. So -2% is the net real return earned by the investor in abroad, maybe in Sweden or Switzerland or in US. In India, in a saving bank, SBI, I'm earning 2.75. In case of ICICI or HDFC, I'm earning 3.5. Bank saving. Positive return hai bhai. Great. What is the inflation? 7%. So 3.5 minus 7%, 2.5. My real rate of return is 2.5. Actually, we Indians are worse off. Among the last economy, India is the worst economy as far as net real return. It's unfortunate our politician, unfortunate our regulator, and our fund houses does not showcase that actually we Indians are in a bad position. I am very, very vocal about it, that RBI, okay, to save some people, have killed the savers, have killed the people who are into senior citizen, people who are conservative. Why? Because yesterday, or maybe 1 year, 2 year back, I was getting 6% return, 7% return. But now I'm getting 4% return. From 6 to 4, it looks like 2% is down. But is it 2% down? No. So huge 2% of that. That is one third. Your return is down by one third, 33% is down. So if I am earning, say, on 1 crore, I was earning 6 lakh rupees, 6%. Now I'm earning how much? 4 lakh rupees. Down by 2 lakh. But actually I'm down by 33%. Now what happens to those people who are senior citizen or a conservative who's not comfortable with equity? They are forced to invest into equity market which they are not comfortable with it. And which we are seeing today in market, that there is a FOMO effect, that is fear of missing out. People who are not invested in equity market are running in. People who are not seeing good return coming from a fixed income portfolio, they're moving into equity without knowing what is equity market. And God forbid, if something like March 2020 happens again, or worse, like 2008, please understand 2008 was far worse than this one. Because in March, it just happened in 1 month and it reversed. But in 2008, the Nifty or Sensex took 5 years to touch that all-time high. In Jan 2008, Sensex was at 21,000 level. It took way back to September 2013, more than 5.5 years to touch 21,000 again. 5.5 years. Whereas in 2020, in a span of just 8 to 9 months, Sensex and Nifty touched all-time high. Please understand, just because it happened in the past, in just 1 year, it will again happen. Maybe next time the correction happens or something happens badly, maybe it will take 3 years or 4 years. So please do not invest into product just because of returns. If you are not comfortable, please do not invest into that. My personal view is RBI, maybe in 3 months, 6 months, or maybe in 12 months, they have to increase interest rate because our inflation rate is very, very high. It's already 7%. But if you look at few factors, oil price. Yesterday, petrol price in Mumbai has touched all-time high. Okay, globally, oil prices increasing. Second is basically your food. India as well as internationally, food prices are increasing. Cement, steel, copper, aluminum prices are increasing. All your like motor cars, vehicles, they are increasing the price. So all is going to get incorporated. So inflation is going to get impacted badly in coming years. Okay, unless there is some play done on the inflation number. In such a scenario, RBI will be forced, if not in 3 months, 6 months down the line, maybe in 12 months down the line. Interest is going to definitely go up. In such a scenario, my advice would be to is lock your money for a short duration. So invest into short-term fund or into arbitrage fund for next 6 month to 12-month perspective. Vishwas Joshi, is it right to redeem equity mutual fund and start new SIP since market is high? Can you advise 5 to 7 fund? Vishwas, doesn't make any sense. If I take my money from left pocket to and put it in the right pocket, what difference is going to make? I'll end up paying some taxation. I lose up. When you pay taxation, you're paying 10%, 15%, what it is. So don't look from this strategy. If you already invested, stay invested, keep adding in SIP format for next 3 years, 5 years. I said market may correct. It may correct badly also. You never know. None of us know. If I was knowing where the market would be, I would not be working with Motilal Oswal. I'll be sitting at home and doing my own work. So none of the fund manager knows about it, kya market hoga. If you ask me today evening, forget about 1 year, 2 year down the line, ask Sensex positive close hoga कि negative close hoga, मुझे पता नहीं है. How can I talk about 1 year or 2 year down the line? Okay, yeah, what we can figure it out. Okay, over the last 40 years, this has been the trend. So assuming if economic grows up, because we are seeing a lot of positive news. Let me be upfront with you. I told you the valuation part. On valuation front, be it market cap to GDP or maybe on the basis of PE ratio, PB ratio, dividend yield, very bad. But there are good news. And first and foremost is GST number. For first time, we have touched 1.5 lakh trillion. 5 lakh crore, that is 1.15 trillion, sorry, 1.15 trillion, which is 1.5 lakh trillion crore rupees of done in month of December. And for the last 4 months, GST number is going up. Second thing, the railway freight, the travel freight, all prices are increasing. There is excess activity, economic activity is happening around. The promoters, the manufacturers are giving positive commentaries. We also started seeing post unlocking. We have seen a lot of activities happening. Is new manufacturing setups are coming in into India from due to China plus one strategy. Our own promoters, manufacturer are thinking of expanding their manufacturing stuff. Service is definitely slowly and steadily improving. So there are a lot of good news are happening in. Okay, we are seeing a GDP from negative 24% has is now negative 7.5, and maybe this quarter Q3 or maybe Q4 we may see a positive return in case of GDP. But then there are too many macro numbers, but they are positives. It's going to happen. But at the same time, there is huge flush of liquidity. Just for your information, interest rate in US, 10-year US yield was trading below 1% for a long period of time, below 1%. In last 2 days, it is already 1.10. So US inflation rate, interest rates are going up because slowly and steadily, the investor has started figuring out that inflation in US will go up. Over there, the Fed also is managing it, okay, flushing the money. But there is always a limit to what you can do. So if inflation expectation goes up in US and interest rate goes up, we may see some reversal of liquidity. So I said, come with the mindset. In next 3 years, there'll be a volatility happening in. But since I'm going to create wealth for next 5, 10, 15 years, let me stay invested for a long period of time. What mutual fund would I suggest for senior citizen category? Sir, the suggestion which I made for someone who's starting off fresh, same can be applicable to senior citizen. Of course, if you are already experienced person, you've been investing into multi-cap and mid-cap and small cap for a long period of time, then stay invested and keep investing. Romaldo, please explain tax with respect to MF dividend versus HWP mutual fund. Okay. Dividend, as I said, whether you're getting dividend from stock, say Infosys giving dividend of say 10%, 30%, the entire dividend is taxable at your marginal rate of taxation. That is, if I'm at 30%, I'll be paying 30% taxation. Same in mutual fund, if I get any dividend, I'll be paying at my marginal rate of taxation, which is 30%. In my case, example. Now, in case of SWP, what is happening is you're withdrawing money. So when you're withdrawing, it is a redemption. Okay, just like SIP is an investment, monthly investment. But if you look at SIP, is nothing but top up of fresh investment on a monthly basis. It's just the nomenclature given SIP because you're investing every month. Systematic investment plan. The same way, you're redeeming physically once you're giving the advice, but actually you're redeeming every month. So it's treated as a redemption. And when you're redeeming the amount, since you are investing into equity fund, when you redeem, there's taxation applicable versus short term or long term. If you're redeeming within less than 1 year, then short term capital gain tax will be applicable. Now, what is the short term capital gain tax for equity? 15%. For more than 1 year, 10%. So compared to dividend, you're saving your tax by 15 to 20%. And in case of debt, if you're withdrawing after you are starting SWP after 3 years, you're paying 20% taxation with indexation. So with indexation benefit, you'll be paying a very low taxation. So if you want to be a tax efficient product, okay, that's what I said. ELS is always, we think mutual funds with ELS taxation. No, mutual fund is excellent compared to any other product. So you get this tax advantage. So you have to do something which is better and faster way of doing it. Someone wants to know the product scheme. I'll just show you. Markets are making new high. If I invest, how to suggest I go for lump sum? Please understand, if you're investing, if you're having large amount of money today, my personal view would be, if you have lump sum amount, invest into arbitrage fund and do STP into the equity fund which you want to do it. And if you want to do it SIP, SIP is always welcome. Okay, whether you want to do for 6 months, for a 3-year horizon, or maybe for 15-year horizon, you can look at it. What is view on my gold? Okay, I'm not a gold expert per se. Please understand, when does gold work? The gold works when there is the economic volatility. There's the war expectation, or there is something like, of course, now Trump is on the way out, but you know, Trump is to create a lot of nasty thing in last 4 years. So as and when there is the uncertainty in the economic market, the gold is to go up. In last 3 years, gold has given excellent return. It's already, I think, again back to 1910 or 1920 per ounce. Okay, there is the expectation that, as I said, inflation in US is slowly and steadily moving up. Interest rates are moving up. So if inflation goes up, uncertainty in the economy market goes up, gold, there'll be demand. But do not expect the same rate of growth which you saw in last 2, 3 years going forward. You need to have gold as an investment. And when I say gold, no physical gold. Either it should be gold ETF or sovereign gold bond. It's an excellent product, sovereign gold bond. Invest into, and your overall holding of gold should not be more than 5 to 10%. 5 to 10% is sufficient in gold, and rest 90% should be invested into equity, debt, depending upon your risk profile. If I'm a high risk person, that aggressive person, I may have around 60 to 70% into equity, rest into debt. If I'm a moderate, maybe 40-40. And if I'm into a conservative, minimum 20 to 20%, minimum 10 to 20%, even if you're aggressive, sorry, conservative, or you are a senior citizen, please have around 10 to 20% into equity, because you need to have growth in your portfolio. You can't be completely dependent on fixed income. People who are there in the forum who may be 60-70 year old will definitely know there was a time when हम लोग बोलते बैंक का FD डबल होता है 5 साल में डबल. What was 5 साल में डबल? It was 15% interest. Now from a 15% interest rate 20-25 years back, today we are at 5% or 6%. You know how much years it will take? It will take around 12 years for the money to double from 5 years. So you need to have equity as your part of company. As there are some people who want to know what is the recommended scheme we have. So let's show the recommended scheme at Motilal Oswal. But please understand, this is only for information purpose. Don't treat as this as an advice. You please connect with partners or with your relationship manager. So these are the large cap fund which we are recommending currently. If you see, we have highlighted 5 years. We not highlighted 3 years because we want everyone to focus on a long tenure. 5 years is the minimum. But look at the return this company's large cap has given in 10 years. If you're investing in 12 lakh rupees, 10,000 rupees, same example which I said, 10,000 rupees on first of every day for last 10 years, you would have invested around 12 lakh rupees. You are generated 24 lakh rupees of return. This is taken into consideration all the ups and downs which we saw in last 10 years. So this is on the large cap, this is on the multi cap, this is on the mid cap. This is what we have as a recommendation. And within the small cap and hybrid, this is our recommendation. My personal suggestion would be, just don't do DIY, that do it yourself. अच्छा लगता है DIY करने के लिए, but जब फटका लगता है ना, it's very, very painful. So please be careful with your money. End of the day, it's your own money. And if you are in starting off, just starting off, maybe you can take risk with your money. But if you are into 50s or already you're retired, don't risk with your money. Okay, play safe and ensure that you invest as per your financial plan, as per your goal. Please note, advisor zaruri hai. You know, there are a lot of ads saying, okay, invest into direct mutual fund. Great. Please figure it out how many of friends of yours who invested into direct mutual fund and lost money because there was no one to handhold him or her when market corrected in March, April, May. No one supported him, sir, kuch mat karo. Stay put in March, April, May. The customer who had stayed put in March, April, May would have made a huge amount of return just by staying invested. And that's the power of a good fund manager, a good advisor. So please ensure you have a good financial advisor with you. Please understand him or her, what qualification they have, what experience they have. Not necessarily all the advisors are good. Okay. Same way that all the fund managers are not good. Necessarily all the people who come on television are good. So take everything with a pinch of salt. It's your money. Please ensure you put good effort on that. So wish you all the very best, and I hope this calendar year starts on a very, very well note for you, and hope this session has been insight for you. Thanks a lot. Wish you all the very best. Thank you for joining.